Good morning, ladies and gentlemen. Welcome to our MERICS members briefing on this Thursday, June 6th. I am Claudia Wessling. I'm the Director Communications and Publications at MERICS. I will guide you through this very brief session where we will introduce you to our latest study that was just published yesterday on our website and on the website of our partner, Rhodium Group. The title is Dwindling Investments Become More Concentrated, Chinese Foreign Direct Investment in Europe in 2023. The study is the result of a long-standing collaboration that we had with that we at MERICS have with Rhodium Group looking into Chinese FDI in Europe. We've done that for a couple of years, and things have changed, as our authors will show you in a few minutes. As the heading of our study suggests, Chinese FDI in the region has slipped further, reaching a historic low. And what stands out, among other interesting findings, is that Hungary received a large proportion of all Chinese foreign direct investment in Europe, overtaking even the so-called big three economies, Germany, France, and UK, as the main recipient. What does this mean to all of us, to developments for the European economy? Why have investments increased again, decreased, and which motives lie behind Chinese investment in Europe nowadays? To explain this a little more, I have two of the authors here with me. Agatha Kratz is with us, Director of the Rhodium Group. Hi, Agatha, good to see you. And we have our own Alexander Brown here. He's an analyst in our economics team. Hi, Alex. Proceedings, Agatha would kick us off with a few remarks and then would hand it over to Alex. And afterwards, you in the audience get a chance to ask your questions. Be reminded that this is off the record, so you can be really open, and our speakers here will also be very candid if need be. You can use the raise hand function afterwards, or you can just and ask your question orally, or you can just write into our chat here. But that's it for now from my side, and I would hand it over directly to you, Agatha. Floor is yours.
Thank you, Claudia. Thanks for the good introduction and for already previewing some of the surprises this year. We had gotten into the habit of saying a little bit of the same things over and over again, because we're in a new era of Chinese investment in Europe. And so the news was almost always that Chinese investment in Europe was declining and that EV was dominating. We're still going to tell you this year, and we'll get into that in a minute, but there are a few surprises and quite interesting surprises this year. So this is, as usual, the very high level take on where we are on Chinese FDI into Europe. And by Europe, by the way, we mean EU27 and the UK. This is the legacy from, well, back when the UK was part of the European Union. So this is what you should have in mind when we look at this. And the first news is the same as the news we've been giving you since 2016, which is that Chinese investments in Europe have declined a little bit between 2022 and 2023. We're now at 6.8 billion in Chinese investment. That is reviewing all transactions over 1 million. There's a little bit more, of course, happening at the lower level, but we're marginally below the 7.1 billion that we had registered in 2023. The reason for this is manifold. As in previous year, you still have pretty strong capital controls in China, an economic environment in the Chinese economy that's tightening, weakening, slowing Chinese growth, an ability of Chinese companies to go out and invest overseas that is a little bit restricted by the current conditions in China. There's a lot of appetite for investing outside of China because of margins coming down in the Chinese economy, but it's still kind of a push and pull at the moment because of those conditions. And then here in Europe, of course, you have growing scrutiny of Chinese investment. You have EU-China relations that are getting tenser by the year. And so this is also affecting the desirability of Chinese companies to come to Europe and invest. If we look at the colors here on the slide, and the red color in particular, the key driver really in the decrease has been the complete free fall in M&A. Back in 2016, M&A was 87% or at least above 85% of all Chinese investment in Europe. That has come down drastically. And this year, we haven't even seen any transaction above 200 million, which is really a first. I mean, for years, we at least had a couple of transactions above 1 billion. Completely out of the picture this year. And so we had a little bit of M&A activity, but it's fallen drastically, 48% over the 58% over the previous year, and now at 1.5 billion total. And so we're emerging now in this new era where greenfield investment is the majority of Chinese investment. It was already the case in 2022 with 51% of all investment, but in 2023, it's even more marked. We're now 78% of all Chinese FDI in Europe going to greenfield investment. And as you can see in this little differentiation we've made between the dark green and the light green, EV investment, which is the light green, is really the top investment destination here, with a few very large, in that case, very large multi-billion projects from CATL, ISEC, Royal Cobalt, and a few more over the past few years. The last thing that we don't speak about much anymore, because somehow investment have changed so much. Most of this is private. There was a time, especially around 2015, 16, 17, when the majority of Chinese investment in Europe was SOEs, and as SOE driven, we're now in a very, very private territory at this stage, especially because EV is so dominant and private companies are so dominant within the EV space. So that's the high level picture. If we dive in a little bit to the next slide, I think the second finding, which is where we get to the surprises, is this incredible emergence of Hungary as a destination for Chinese investment. If you took pretty much any year of the past 20 years before 2022, apart from 2011, when there was one big transaction in Hungary, but any year before 2022, Hungary would receive on average yearly about 85 million euros in Chinese investment, a very, very low level compared to the rest, less than 1% most years. We're now completely in a completely different era. In 2022, 21% already of Chinese investment in Europe was going to Hungary, 1.5 billion compared to 85 million, as I said. Last year, 2023, we were at 3 billion of investment total going into Hungary, 44% of all investment in Europe. So that is a sea change, very, very different situation. It used to be that the big three countries of France, Germany, and the UK were almost any single year capturing at least half of Chinese investment in Europe. We're now 35% for the last year, and then the rest of Europe is capturing very little in this context. Sweden and Finland might kind of come back up in the next few years because there were big EV related investments announced there, especially in anode material production. But once again, a very different picture from the previous years. And then if we go to the next slide again, a little bit of continuity here, because we're so low in terms of Chinese investment, and because in the EV space you have such big actors investing in very big manufacturing plants, you have a huge concentration. 69% of all investment was made and conducted by just 5 key investors, all of them in the EV space, which is one of the reasons why EV also concentrates about 69% of all investment in Europe last year. So highly concentrated in terms of investors, highly concentrated in terms of sectors. This is also what we see on the next slide. This, as repeating myself a bit, but this importance of EV-related investment in Europe. It used to be in 2015-16 up to 2019 that M&A and EV-related M&A was dominating the picture. We're now very much in greenfield, EV greenfield territory. For a few years, and this is the second surprise of this report, for a few years, this was very, very much concentrated on battery production. And so CATL and ISEC and players like this setting up a battery plant in Germany, in France, lately very much in Hungary. But this year, a little bit of a change with upstream and downstream from battery and within the EV supply chain, seeing quite a bit of activity. We've had a CATL supplier, Semcorp, invest 340 million euros in a lithium-ion separator factory in Hungary. And we have, as I mentioned, upcoming investments probably in Sweden and in Finland for anode material production. So you see that upstream from batteries, you have quite a bit of activity with tier 1, tier 2 suppliers starting to come in and gather more ground in Europe. And then downstream, you also have a few investment announced. Volvo, which is Chinese-owned, Geely-owned, announced a big production plant in Slovakia to produce EVs, which makes also Slovakia one of the key recipients of Chinese investment last year, and so much amplifying to a certain extent Central and Eastern Europe's importance. But you also had announcements, many of you will have followed BYD, Great Wall Motors, announcing their interest in setting up factories in Hungary. And then Chery contemplating a JV-based investment in Spain, and more potentially to come, especially in the context of potential duties on China-made imports of EVs. So that was the second very interesting development for last year. And then third one, if we just go to the next slide, one of the big takeaways, has always been that EV is dominating. But what we did is, for this year, we went beyond EV. And so we took away kind of EV investment from the equation, and we said, what remains once you've done that? And we realized that 3 sectors in particular are quite resilient beyond the big EV kind of concentration. And those are healthcare, consumer goods and services, including entertainment, and ICT, all for their own reasons. And Alexander will go into this, but it is a key. It is a key development to see that those sectors, in a way, compared to energy and infrastructures, who have completely plummeted minus 90% from the height of 2016, 2017, those 3 sectors are remaining quite resilient in the mix. And so I'll pass it on to Alexander to tell you more about it.
Thanks, Agatha. Yeah, so because the story is so focused on EV investment, this time around we thought it would be a good idea to dive a little bit deeper and look at these other sectors, because they also provide a good indication of in what areas investment is still remaining relatively robust and might provide more momentum for Chinese investment going forward. And as Agatha mentioned, we're seeing these primarily these three sectors: consumer products, the entertainment sector, and healthcare, as well as ICT. There's still a significant amount of interest from Chinese investments in these sectors. And in this chart, we've got the breakdown of how much each sector is accounting for in the overall share of Chinese investment when we take EV away. And what you can see for 2023 is that healthcare emerged as the second largest sector. So it accounted for about a quarter of all Chinese investment when we take EV investment away. And that's quite significant. I think what's also very interesting is a lot of these sectors are areas where private companies are the dominant players. So it's really these private firms which are continuing to take advantage of these investment opportunities in Europe. And we look a little bit further back at 2021 and 2022, we see there that there were significant investments in consumer products and the entertainment sector, and those are down to large acquisitions which were made in those years. So 2021, you had Hill House Capital acquiring the household appliance division of Philips for 3.7 billion euros in 2021. And then just in 2022, Tencent made an acquisition of a game developer in the United Kingdom that was Sumo Digital for over 1 billion euros as well. So these are less sensitive areas, consumer-oriented products, and the entertainment sector. And so there's less issues with Chinese companies making big acquisitions in those fields. If we move on to the next slide, looking a little bit closer at the healthcare sector as it's emerging as the second largest sector for Chinese investment after EV. What's been interesting to notice here is that there's been a significant amount of interest in the medical devices sort of subsegment of the healthcare sector. So there's clearly a strong interest in the technology offerings which European firms which are producing medical devices, which they offer for Chinese investors. And what's also interesting is that although most of these deals are sort of medium-sized acquisitions of companies, there's also been a number of examples of Chinese companies investing in production facilities in Europe to also expand their manufacturing footprint here. So there were a couple of examples, particularly from Wuxi Biologics, which is also investing in manufacturing plants in Ireland, and it also acquired plants from Bayer in the past couple of years, which it will be able to use to do that. I think the healthcare sector is a really interesting case, also in terms of just how open it is, because since the pandemic, there has been a lot more sort of scrutiny on that sector, or greater understanding of the strategic relevance that it has for countries. But so far, we've seen that not many deals have been blocked. That we found hardly any examples of that which have been publicly announced. There was one case where a ventilator manufacturer, Higher Medical, was acquired by a Chinese firm, IronMed. That was initially blocked in 2022, but then this decision was overturned last year. So the sector still remains relatively open at this stage. That might change going forward. We saw biotechnology was listed among one of the 4 critical technologies identified in the EU's economic security strategy. So that will that means that it will be investigated as part of a risk assessment, and that could lead to further restrictions down the track. But at the moment, the sector is the healthcare sector is still relatively open to Chinese investment. If we can go on to the next slide. We also had a look at the situation with investment screening overall within Europe as it stands today. And we found quite an interesting trend in that the number of investment screening cases related to Chinese firms, when we look at either the EU level or the German level specifically, the overall share related to Chinese firms has been decreasing, as has the overall level of investment from China to Europe. So it's not exactly clear what is at play here. It could be that increased regulatory oversight is leading to a decrease in Chinese FDI to Europe. So some Chinese firms might decide the hurdles are too high, or their chances of successfully completing an acquisition are too low, so they don't even bother to engage with that. Or it might just be the fact that for other reasons, Chinese investment is decreasing, and so the overall share of investment screening cases involving Chinese firms is also decreasing. We can't really pinpoint what is at play here, but it's probably some combination of both. And when we look at the examples that we find of publicly announced investment screening deals related to Chinese firms, we say there's still quite a mixed picture in terms of what their outcomes are. There are still a number of deals which are being permitted in sectors like B2B platforms, and even areas like medical equipment and semiconductors, which are more strategic. And also a number of examples where deals are being permitted, but with some restrictions or amendments to the deal. So probably the most prominent case last year was Costco's investment in the Hamburg terminal, which was finally approved after a lot of discussion, but the share which they acquired in the terminal was reduced from 35% to just below 25%. So this is becoming a reoccurring pattern where governments are looking very closely at investments from Chinese companies, and they're approving them in many cases, but they're imposing some restrictions to make sure that their interests are not damaged. And finally, there are also some cases where Chinese investments are just being blocked, like in satellite technology or other areas of semiconductors. So the scrutiny is increasing overall. And moving on to our final slide for today, how do we see things evolving this year and beyond? Well, I think our key message is really that the message that we've been repeating for the past few years, that Chinese investment is decreasing, is at low levels. That's going to remain more or less the same. We don't expect that there's going to be a significant uptick in Chinese investment to Europe in the coming years. What is important to recognize is that this investment that Agatha was talking about in the EV sector, we have a lot of large-scale greenfield investments, and now we see more in the upstream and downstream segments of that sector. Those will provide a base, a sort of a foundation for Chinese investment going forward. So it won't fall off a cliff. It won't completely disappear. But ongoing investments in the EV sector and these other sectors that we've identified, like healthcare, consumer goods, entertainment, that will mean that it remains relatively robust at these lower levels. And we see that there are a number of drivers which will continue to push forward investments. So we have the intense competition within China in certain sectors, including the EV sector, which is pushing firms to invest overseas. We also have important players in that sector, both upstream and downstream, which are following the initial investments which have been made in battery factories in Europe. And we also have just this ongoing interest in acquiring technology available in Europe, which is certainly the case in the healthcare sector and the ICT sector. I think it's also important to mention that in comparison to other advanced economies, particularly the United States, Europe is still relatively open, and that makes it highly attractive for Chinese investors. But there are a number of constraints which are preventing Chinese investment from increasing, significantly in the coming years. As Agatha mentioned, the current situation, the current economic circumstances within China mean that Chinese firms have a weaker financial position. They simply have less capital to invest overseas, and the competition in many sectors means that they also are facing reduced margins. It's also been clear, looking at the top policy announcements from Beijing, that the government's priority is really strengthening the industrial and technological base of China itself, and so they're less likely to be to approve foreign investments, and companies themselves might decide it's more in their interest to focus on local investments rather than foreign investments. And finally, the situation, or the market access situation for Chinese firms in Europe is also becoming more uncertain. So we've seen, the EU roll out a number of investigations through its foreign subsidies regulation, which came into effect last year. It's also activated the international procurement instrument and is looking into the procurement of medical devices in China, which could eventually limit the market access for Chinese firms in Europe. We also have ongoing debate here in Europe on EV adoption targets, which makes the market potential of that sector in Europe also more unpredictable for Chinese firms. And so in all these areas, the attractiveness of investment in Europe for Chinese firms is becoming more limited. I will leave it at that, and we can move on to the Q&A.